In today's video, we have Rick Rule. He is one of the most successful commodities and natural resource investors out there in the world today. And he's going to help us make sense of what's happening in the financial system, in the stock market, in gold and silver. And so if you enjoyed today's episode, first, I want to thank you for listening. If you do enjoy it, you can smash the like button on this video. You can give us a comment right there down below for the good old-fashioned YouTube algorithm. I want to thank our sponsor, Vizsla Silver, one of our favorite silver and gold mining stocks. So thank you, Vizsla Silver. And Rick, it's good to see you.
Always a pleasure to be with you, Jake. Thanks for having me back.
Yeah, so it's amazing watching what's happening from my perspective, looking at whether it's inflation, whether it's interest rates rising, whether it's every day, everybody thinking the stock market's going to crash. It's kind of a strange time. I think as myself, who is invested and invests in mining stocks and commodities, a lot of those things from a fundamental perspective seem really attractive, but at the same time, we're covered in such incredible levels of fear in the world. And I was wondering, how do you make sense of it?
Jake, perhaps the only good thing about getting old is that you've seen most of these plays before. In my case, crowding age 70, I've seen them several times before. Let me give you a few examples. People say to me, Rick, I've heard your reasons why the gold stocks and gold should go up. And I think they're all true. Why haven't they happened? Because things take time. I remember, as an example, many of your listeners won't because they weren't born, the late part of the decade of the 60s, when inflation was clear and present. High numbers like now in 68, 69, 70, 71, 72. But people had lived through 20 pretty good years, the late 40s, the 50s, the 60s. And inflation for them was an esoteric discussion. It hadn't affected them. After 3 years of getting 3% pay raises in a world of 8% inflation, after 3 years of negative real interest rates on their savings, when they came to understand that their living standards were deteriorating markedly, all of a sudden, inflation made sense. So we've had a year of headline inflation. People are aware of inflation. People are angry about the fact that gasoline prices go up. Perversely, they blame Putin rather than Biden. People haven't been bitten by inflation because we've been through 40 benign years. People expect things to get better and better and better. In a year, or in 2 years, when people have watched the purchasing power of their savings decline by 8% a year, while they've been paid 2% a year on their savings, which is to say, after they've become 15 or 20% less wealthy, then the knowledge of the perniciousness of inflation will cause people to act. So what's interesting for me is I've seen this play before. I've seen, too, the play that happened when gold and gold stocks got too cheap in 1998. The absolute inevitability that the gold price would go higher. But despite the fact that it was inevitable, it took till 2001 for it to go higher. And it took till 2004 before people noticed that the gold price had gone higher. The circumstance that we're in right now, the malaise around precious metals and precious metals equities prices, despite the fact that the facts which will cause them to go higher are in the market, is completely explainable by history. It's not explainable by history if this is your first rodeo. But if you're an old campaigner like me, you've seen it before and you're completely sanguine about it.
Okay. If I could make one argument in my head, I look at it and I go, but is this different, at least in the way that the debt levels are so much higher than they were before? And on top of that, with all of these lockdowns and supply chain shortages, it's crazy because we have a channel, right? And we kind of talk about a lot of this stuff, but then there's very mainstream finance channels and they kind of just talk about, I bought this tech stock, they're very mainstream. And there's been some really big mainstream influencers that they're always bullish, and it's here's this tech stock and this stock, and they're selling everything and they're saying, you know, everything is going down. And I think a lot of people, especially after the last few days, as you've seen more and more sell offs in stocks, and a lot of the Federal Reserve characters saying, you know, we need to bring interest rates higher and higher and higher. A lot of people feel like this, like it's different now. And I was wondering, is that warranted or unwarranted? And how do you think that this plays out right now versus when it was a similar situation before, and the results that came during that time versus where you think it's going now?
You've made at least two very interesting points, and probably a third, which you forgot to mention. So let's go through them. The first is that in one sense, the situation is more dire because the level of debt and the level of reliance on government, the government share of GDP, is higher than it ever was, which means that society's flexibility, society's ability to respond to stresses is lower than it was. Debt to GDP is markedly higher now than it was in the decade of the 1970s. And so the risks that conventional savers face are arithmetically higher than they were then. That doesn't affect consumer psychology because, as I say, people don't feel bit yet. People aren't paying attention to facts in the future. They're paying attention to the way they feel. And the way they feel has been generated by living through 40 years of benign economic time in the period 1982 to 2002. But what you say is really, really real. I personally don't believe, as many people believe, that gold responds to all types of fear, which is to say market volatility, equity market volatility in and of itself won't be enough to move the gold price. Similarly, geopolitical fears like war won't be enough to affect the gold price in much for a long period of time. In my experience, negative real interest rates, the declining purchasing power of savings in conventionally denominated financial instruments is what moves the gold price. What happens really in circumstances where there's volatility across financial markets, particularly if that volatility results in a liquidity crisis, is that in the near term, the gold price goes down. It goes down because in a period of illiquidity, sell decisions aren't made by investors, they're made by margin clerks. And anything that has a bid, including gold, will get hit. It's important that people who are investing for their financial future think about the future. And the future is not next week or the week after. The future is 2 years out, 3 years out, 5 years out. And if you do that, understanding that the probability of the circumstance that we find ourselves in with regards to debt and deficits and with regards to negative real interest rates favors gold, and favors gold stocks too, because relative to gold on a net present value, gold equities are extremely cheap. People always look to the immediate past to ascertain what they think the future is going to bring, and that's a mistake.
Some people say this whole thing's going to crash, whether it's including but not limited to equities, mining stocks, housing. Other people say they believe that there may be, a little bit further liquidity event, but then there's going to be a move out of tech and into commodities, and there'll be a movement of money. And I was wondering if either of those two camps you fall into, and if none, where do you fall into on your outlook on this day, which is Monday, April 25th, moving forward?
Warren Buffett famously says that markets are such complex topics with so many variables that you can't understand them. He says that if you spend 15 minutes a year on markets, that you can allocate 15 minutes to your own amusement as long as you don't try and draw any conclusions from them. And I sort of agree with that. I realize it'll be very disappointing to your audience who wants to believe that I'm some old sage with a crystal ball. My crystal ball is cracked and cloudy. I think life involves a series of probabilities and no certainties. And the consequence of that is that you need to assess the probabilities, and your portfolio needs to reflect things that are more likely than not to occur. I believe that we will have a black swan event of some type. I don't know when it's going to occur. I don't know what will cause it, because that's the nature of black swans. And I think that we'll have a confidence in crisis and liquidity that will cause the prices, rather necessarily than the value of a broad range of assets, to decline, to have a precipitous sell-off. If I'm cautious and I prepare for that and it doesn't occur, I didn't lose anything except for some of the upside that I could have had by being more aggressive. But it doesn't change my decision as to what to have for breakfast. If I'm correct in my preparation and we have a broad equity market sell-off, say a 50% sell-off, and we have the kind of decline, and I'm saying this is going to happen, I just think it's more likely than not. If we have a broad sell-off like we had in 1982 in real estate prices and homes that were formerly $2 million homes clear the market at $1 million. If you're prepared for that, it's not an unpleasant event. It's scary, but it's not an unpleasant event. It's a 50% sale. I need to say that personally, I'm bullish on humankind. I have said on your show before, Jake, that in my lifetime, as improbable as it may seem, our individual creativity and tenacity has been sufficient to amortize our collective stupidity. We're still in a place where a young ex-Hawaiian hippie, Jake Ducey, can create 2 monster websites, deliver utility to hundreds of thousands of people from a standing start, and make a small fortune doing it. That's a wonderful thing. We're still in a society where 2 or 3 young geniuses can commandeer a garage in Sunnyvale, California, and out pops Google. So if you ask me what my outlook is in 10 or 15 years, assuming they won't blow each other up with nuclear weapons, it's hugely bullish. It's getting from here to there that bothers me. And I think the ascent to the upside has to slow. If you look at the circumstance that gave us the last 40 years, if you look at the macro trends, one was that we broke the back of inflation expectations in 80, 81, and 82 with very, very, very high first nominal and then marginal interest rates. And we've had a period from 1982 to 2022 with excess liquidity and ever lower interest rates. Well, that's over. But we had other things. We had a wonderful demographic boom. The baby boomers hit their savings and investment years in the late 70s, the early 80s. And so we had this insane demographic boom. But that boom isn't busting, it's dying. So that's over. We had a tremendous advantage with technology, which I think continues. But the advantages that we've enjoyed over the last 40 years in terms of human productivity from technology and communication has been wonderful. And we had a huge advantage from the liberal distribution of technology and communication to frontier and emerging markets. We've had a wonderful benefit from inclusion. I'm not trying to be politically correct, but the opportunity for women to participate in the workforce has meant that we're no longer ignoring the potential contributions of 50% of humankind. And one must remember that in the 70s or the 80s, the picture of authority was somebody who looked like me, an old, fat, bald, white guy. Now, around the world, we have this inclusion of people who don't look at me. It's very likely that the next Google or the next Apple won't come out of Sunnyvale. It'll come out of Lagos or Jakarta. And that's all really, really, really good. What's really, really, really bad is that we have all come to believe that we owe each other things, that utility to an individual doesn't come because of that individual's contribution of utility to others, but rather as some sort of collective birthright. And that's disgusting and it's dangerous because if you believe that your perceived needs are a call on somebody else's means, and you feel like you can coerce that person collectively rather than convince that person privately, that whole set of perceived birthrights is the genesis of war. It's the genesis of political action. As Mao Zedong famously said, all political power logically flows from the barrel of a gun. And the bad thing that we have in front of us, perhaps different from technology, certainly different from freedom. The one real bad thing I see out there is the increasing reliance on coercion and the collective rather than utility generation and individual initiative. Sorry for that long-winded question, but it was answer. Pardon me. It was a big, big question.
Now, clearly, you're bullish on the future. Using your own words on if there's a liquidity event, whether it's now, near term, do you think the response to that would be a new wall of money and a new level of easing because there's an excuse to do that, a reversal of interest rates, a new wall of money printed, or what do you make of when the Federal Reserve is now saying they're going to do tightening and they're going to raise interest rates? Do you believe it? And do you think they would just reverse course in the event that there is a liquidity event?
You've asked me three questions, one by implication. The first is, do I believe that an economic slowdown would result in a new wall of money? Yes, absolutely. The big thinkers of the world believe that they can control human action with liquidity, and thus far they've been right. The thing that you need to worry, let's do that last. In terms of their ability to raise interest rates, right now they've been able to do it, and they need to do it in order to lower interest rates later. They need to have them up now, and they will continue to raise interest rates as long as they can get away with it. My nervousness is that we as a society have grown accustomed to free capital. It's a different way of saying that we believe that we're justified in consuming our seed corn now. What artificially low interest rates and debt and deficits really are is a transfer of wealth from young productive people like you to old lethargic people like me. And that's okay with me as long as it's okay with you. But when it ceases to be okay with you, it's going to be problematic. As we raise the interest rates to the extent that a sclerotic economy can't afford higher interest rates, you will see the interest rate fall very rapidly. The scary part, Jake, I'm interested to see it occur, but I'm afraid to be around if it does occur, would be a circumstance where they printed a wall of money and savers went on strike. Suppose they gave a treasury auction and nobody came. Suppose that the US Treasury had to buy the whole issuance itself, which is to say, rather than hoodwinking savers for 65% of the treasury auction, printing 35%, that they had to print 100%. Suppose there was a broad realization among savers that the currency was a fraud. What implication would that have on markets? I hate thinking about it, but making myself think about it is one of the reasons why I want to have ample liquidity, and one of the reasons why I want some of that liquidity to be in gold, which is, after all, not merely a medium of exchange, but also a store of value, not merely a promise to pay, but payment itself. I'm one of those, Jake, that when I ask myself the questions that you answered me, hope, first of all, they don't live long enough to see the answer. But I also really, really, really hope, with regards to my gold holdings, that form of insurance doesn't pay off, because the circumstance where there was a total repudiation of fiat currencies, where savers really came to understand the fraudulent nature of the US dollar and other fiat currencies and the fraudulent nature of treasuries, the era that would usher in would be pretty scary.
Yeah, that's something that I've always thought about. It's not something that since I've known you, something you've thought about. Yeah, I mean, I know you've thought about it, but it's not something you talk about that much on air, is a better way to say it. But as for myself, I'll speak for myself as a individual that is, I'm in a different, and a lot of people that are listening to this are in a different situation from you, in that you're incredibly successful. You've made your fortune. And there's a lot of people that are looking at this market, whether it's in gold and silver stocks, whether it's in uranium, commodities across the board. They're looking at it and saying, this is an opportunity right now for me to, basically grow my purchasing power substantially. Yet we're in this scenario where things are so crazy. And then you're talking about having dry powder. As for myself, I mean, what is a good percentage of having my money in what looks like compelling commodities and mining stocks versus having it out of the market right now and waiting?
The answer to that question is individual, Jake. I believe that you have to have liquidity, even though having the liquidity is reducing your purchasing power, because I believe that liquidity is in effect an option payment to be able to take advantage of price declines if they occurred. With regards to the type of investments or speculation that you yourself are oriented towards, which were the same type that I was oriented towards when I was your age, I would say that the correct allocation is an amount of money that you could afford to lose all of in a liquidity crisis and not have it change the decision as to what to feed your family for breakfast. In your particular case, I know that your material living expenditures, that is the money that you spend on shelter and food and education and things like that, relative to the money that you make, is fairly minor. You aren't one of these people who are living paycheck to paycheck. And I also know that relative to other people your age, I don't want to disclose too much of what I know about your personal financial circumstance, but you are not what one would call destitute. And you can have a fairly sizable allocation to intelligent speculation if you're willing to do the work, as long as you understand that amount of money, whatever amount it is that's appropriate for you, you could lose all of without it reducing your ability to meet your obligations to your family and your friends. There are some people who are listening to this, Jake, who are living paycheck to paycheck, who don't have any savings. Some people who are speculating rather than to build wealth because they want to use the benefit of speculation on consumer goods. Maybe somebody who owns and drives a Ford pickup truck on time, on payments, and they want to own a Maserati, and they're trying to buy $10,000 worth of uranium stocks on a $10,000 cash advance on their credit card, because they want to turn that $10,000 into $100,000, not to increase their wealth, but rather to increase their material living standards. Those people are not going to come to a happy ending, Jake. Any economic perturbation is going to cause them, never mind not to be able to get a Maserati, it's going to cause them to lose their truck.
So being honest with ourselves about what you can as essentially afford to lose, is it fair to say, is this too much of an assumption that if there's a liquidity event, let's say I have $100 in a portfolio, and there's a liquidity event, and my mining stocks fall by 60% or 70%, is it fair to say that if I don't need the money now, given the macro environment we're in, that after that liquidity event, whether it's a wall of money, whether it's a shift of money, that due to the current supply and demand fundamentals of commodities and this type of nature, that if I can afford to wait on that money, that I am early enough in a commodity cycle that if I can set it and forget it, that there is still an opportunity? Or due to the volatility of the environment that we're in today, is that a poor strategy?
That depends entirely on the nature of the stocks that you own. We are early in a commodities bull market. And as a society, we have underinvested in the means of production for 30 years. Absent a recession or depression, we are going to have supply shortages across a broad variety of commodities. This isn't a maybe. This is going to happen. Look what's happened to commodity prices with interrupting the Russian supply chain. And think about what happens when we have supply shortages in commodities from 20 countries, not just from one. But the other part of the question is much more germane. You talked about a 50% loss. A 50% loss is what you have in liquidity in the biggest and best mining companies in the world. In the period 2011 to 2016, the Toronto Stock Exchange Junior Resource Index, the speculative stocks, fell by 92%. And it actually fell by more because they gamed the index. When a company went broke, they took it out of the index. If the index were intelligently constructed, that index would have fallen by 96%, which is to say that if somebody had $100 invested, if that's the right phrase, in a speculative index, at the end of the period, they would have had $4 left. So the 50% number that you use is illusory, unless the portfolio that you're describing is BHP, Rio Tinto, Exxon, Total. You follow where I'm going with this? If the portfolio that you're talking about is Amalgamated Moose Pasture and Consolidated Orangutan and Prayed For Diamonds, the losses that you will experience will be much uglier. It's true too, Jake, that the return that you get on the portfolio will be more to do with your own efforts than it will be to do with the market, particularly with regards to the juniors. With the juniors, if you assume that there's 2,000 junior mining companies worldwide, if you merged all of those companies into one company and called it Junior Explorco, that company on an annual basis, expenditures relative to sales or takeovers, it would lose about $2 billion a year in a good year. It would lose $6 billion in a bad year. So you need to understand that the junior mining industry taken as a whole is valueless. How much should you pay for losing $2 billion a year? Should you pay 8 times losses? 12 times losses? If they came into favor, should you pay 20 times losses? What that overlooks is that 5% of the population of the juniors generates such extraordinary value that it adds legitimacy and sometimes luster to the 2,000 that are the lame, the halt, and the blind. So a speculator listening to your program who understands that the sector itself will always come back must understand that it's incumbent on them to own companies that will survive and thrive the downturn. And a speculative portfolio means that probably only 5% of the stocks on offer, which is to say sort of 100 out of 2,000, are worthy of merit in a declining market.
What inning of the commodities bull market do you think we're in?
We're early. Yeah, I mean, first of all, I think it's going to go into extra innings as long as we're using the baseball parlance. But I think we're in, the third inning, perhaps. I think we're early on. I think it's difficult for people who haven't been around commodities markets as long as I have to understand that markets work, to understand that we did structural damage to supply in the early and middle part of the last decade. When you take oil prices down as much as we took them down from $100 a barrel to zero, but substantial periods of time at $20 or $30 a barrel, what you did is you caused the industry to defer $1.5 billion or $2 billion a day in new project expenditures and sustaining capital expenditures. And if you do that, you can't repair the damage to productive capability. You particularly can't repair the damage to productive capability if at the same time that you aren't making sustaining capital investments, that your cost of capital is going up because some young Swedish woman or Congress is unveiling against carbon. You have a circumstance now where the oil and gas industry, as an example, is still decapitalizing. They are still returning capital to shareholders rather than making new project expenditures. The inevitable outcome of that is that supplies decline, and supplies are going to decrease much, much, much faster than demand is going to increase. Is going to decrease because demand isn't going to decrease. It's going to increase. I'm using oil because it's a very, very, very large example. But the same thing could be said for copper. The same thing could be said for nuclear. The truth is that we as a society have underinvested in the means of production around natural resources to some degree for 30 years and extensively for the last 8 or 10 years. And absent a global depression, the chickens are going to come home to roost. Our ability to meet demand with supply is going to be severely challenged.
Well, that was beautifully said. So for everyone listening, we're going to do a part 2 on uranium. I want to encourage everyone to check the link out in the description below, where you can submit your natural resource portfolio to Rick, and he can rate it for you for free in the description. If you enjoyed this video, make sure you hit the like button on it. Give us a comment down below that says Rick Rule Rules. Rick, did I miss anything?
Yeah, a couple things. I've learned, because I'm now retired ostensibly, that I can be of more use to your viewers. As an example, yes, by all means, if you care what I think about your natural resource portfolio, submit it to me and I'll rank it for free. In addition, if you are an accredited investor, it turns out I can tell you what private placements I do because I'm not soliciting, because I'm not a broker. I don't get paid. There's no solicitation. So if you're interested in private placements, in the question and comment section with regards to rankings, say placements. And then finally, Jake, as I think you know, I'm celebrating retirement by starting a new bank. If you are uncomfortable with your current bank, if you'd like a bank that's an old-fashioned bank that has stuff like money in it, that lends against good collateral like gold, if you want a bank that pays in the top decile nationwide in terms of deposit interest rates, in the question and comment section, write bank. When we get our charter, I guess I should say if I get our charter, we will certainly distribute information to people about how to deposit with us, how to lend with us. As I say, a sort of a new kind of bank, not a derivative speculator, but rather a group that does good old-fashioned, honest banking, paying depositors reasonable returns, keeping their money safe, and lending to people who have real needs and real collateral.
Very cool. So be sure to check that out in the description right there down below, and head over to part 2, which I will link in the comments as the pinned comment, which is going to be on uranium. Thanks for watching, and we'll see you on the next one.